right, good to know.
Hi, everybody. Barbara Friedberg here. We're going to be talking about alternative investing today. And we have with us David Chan. He's with FarmTogether. So David, welcome.
Hi, Barbara. Thanks for having me.
David, why don't you tell us a little bit about yourself?
Certainly. So I ended up in farmland investing through, I think, a little bit of a funny path. So Barbara, I know you grew up on the East Coast. I heard we were chatting just before this. I'm also from the East Coast. So I grew up around lots of different kinds of weather, tornadoes, hurricanes, blizzards. And so as a little kid, I loved meteorology. I ended up studying meteorology in college. And shifted gears more towards studying climate science and how our climate is changing. And really, I came to the conclusion that we already know what we need to know about climate change. Now we need to do something about it and to implement through industry. And I think agriculture, and more specifically farmland, is really uniquely positioned to address climate change and in a circular way, because the way our climate is changing is going to impact where it is suitable to grow certain types of crops today versus in 10 years versus in 30 years. But also the way we manage the use of land can either positively impact the environment by sequestering carbon and improving soil nutrition, or we could have an adverse effect and we could exacerbate the issue further. So that's sort of what drew me to agriculture. And I've now been in the ag space for over 7 years. I've worked in investment banking. I helped start an ag data company called Grow Intelligence. And then I also worked with an institution, Prudential, doing farmland investing, and also in agricultural private equity. And all of that led me to FarmTogether, where I think this is a great asset class. And at FarmTogether, we're trying to make it accessible for retail investors.
Great. So you have a real kind of love of climate change, and not a love of climate change, clearly, but a love of helping to improve the damage of climate change and to help manage the problems that has caused.
Absolutely.
And you're kind of channeling that into the investing sphere. Is that right?
Absolutely. And I think, I hope, but I do believe this, that over the next few years, I do think investors are going to require more from managers in which they entrust capital to, beyond just financial returns. And I think farmland is uniquely positioned to deliver very competitive financial returns in an uncorrelated asset class, while also addressing so many environmental, social, and governance factors. If you think about farmland, the asset class is outside. It's deeply intertwined with the environment. The labor force is often migrant workers. The community is often very much involved in the daily operations. I don't think there's another asset class that's as deeply interwoven with ESG as farmland is. And so you can make an extraordinarily positive impact if you do all of those things right and identify them as opportunities to be impactful and be intentional, work with the best operators, track sustainability in a quantifiable way, and really think about not just financial return, but broader holistic returns. And so that's what really drove me towards farmland. And at FarmTogether, I'm happy to chat a little bit more later about our sustainability protocols, but it's something we take very seriously.
Now, FarmTogether fits in what's called the alternative asset class, which is not stocks and bonds that most investors get introduced to in the beginning. So switch gears a little bit for us and let us know what is the benefit of investing in an alternative asset class, and what does that actually mean?
Certainly. So I think it's a timely year to ask this question following 2020, which I think we can all agree was an outlier, to say the least.
Let's hope so.
Let's hope so. alternatives are called alternatives because they are alternatives to mainstream asset classes like public equities, ETFs, public bonds, fixed income, and they're comprised of private equity, which is same as public equity. It's equity ownership of a company, except that company is not publicly listed. It's a private entity. It has private investors, different governance protocols. Venture capital is another alternative asset class. Venture capital is where investors invest in high growth, early stage businesses, entrepreneurial ventures. Real assets is another large alternative asset class, and real assets is comprised of real estate, so commercial real estate, residential real estate, farmland, timberland, infrastructure is another example as well. So all of these are investable asset classes that don't fall under the confine of a publicly traded equity or a fixed income product. I think alternatives today are very important to think about because for the past, I don't know, 3 or 4 decades, maybe even longer, the conventional wisdom has been for most investors, a 60-40 portfolio is the most suitable option. So what does that mean? It means a portfolio where 60% of the portfolio is comprised of public equities and 40% of the portfolio is comprised of bonds or fixed income products. Well, in 2020 and 2021, we're now living with real interest rates at basically 0%, and bonds are effectively also near 0%. We have negative yields in many markets across the world, including Germany and many other European major economies. And so it's hard to justify that 40% of the investors' portfolio should be in 0 to -% investments. And so, you know, I think now we are seeing more and more economists challenge this previously assumed conventional wisdom that fixed income should be such a large part of a portfolio, coupled with the volatility that we've seen in public equities. The stock market in 2020 was, you know, basically King Ka, if anyone's familiar with the Six Flags roller coaster. And we had highs and lows and everything in between, and it was very choppy. Furthermore, I think investors look at the stock market, look at broad indices like the NASDAQ or the S&P 500 as barometers of economic health. Well, we lost an entire quarter of GDP last year and the stock market was still at record levels. So is it really indicative of economic health? I think that's a fair question to ask. And so all of this has really transpired to beg the question of, you know, should we reevaluate the 60-40 portfolio and should we think about alternatives? And alternatives, again, being those asset classes like private equity, venture capital, real assets that are perhaps more defensible, perhaps less correlated to broader market moves, more insulated from events like COVID-19 and other macro events. Does it make sense to have that be a more sizable part of an everyday investor's portfolio? We, of course, would argue yes. And I'm happy to share more about some of the facts around farmland performance over time. But that's what we're seeing today. And we think, you know, hopefully 2020 was an outlier year, but, you know, you certainly want to have alternatives in your portfolio to protect yourself from future years. Knock on wood, we don't have many of them, but future outlier events.
You know, alternatives have become much bigger within the investment sphere recently. And part of the reason has to do with the fact that they are less correlated with stocks and bonds. And what that means is, for example, when stocks go up, great, we're all happy. But when stocks go down, we don't want all of our portfolio to go negative. And so when we say an investment is less correlated, that means that it might shore up the negative returns during a downturn. And that is the potential advantage of investing in alternative type investments. Another thing that we found is that alternative investments are becoming more important for exactly the reason that fixed income returns are terrible. The interest rates have not been this low in decades, if ever. In fact, the average return on bonds historically is 5%. Now, I saw a chart just recently where when you take into account inflation, bond yields are negative. So that's a lot of support for the idea of investigating a little bit of investments that might not have held any interest to the average investor in the past. So just to sum up, David mentioned different alternative type investments might include investing in venture capital, private equity, things like gold. It might also be something like Bitcoin, or it might be crowd-funded real estate. And today there's all different types of those investments available. But I got to tell you, David, the farmland investing is really a new asset class and something that in my decades long of investing, I haven't seen available to the public until very, very, very recently. I appreciated your conversation about the importance of farmland. And I think during 2020, when we saw food scarcity and cutbacks in the supply chain, we realized, wow, this stuff really matters. So tell us how people can actually invest in farmland, who should invest in it, who shouldn't, and kind of what kind of risk reward profile an investor might be able to find.
Certainly. So Barbara, you said one of the favorite lines I always hear, which is that farmland is a new asset class, and I agree with most of that. It's a newly available asset class. I would qualify, but it's funny because I always argue. I hear that all the time, and I think it's the oldest asset class. It has
well,
to.
It is. Sure, because that's how people ate forever. So you're absolutely right. And hey, bring it on. Because despite my decades of investing, I don't know everything. So please don't mind me at all. Confront me at any turn.
Thank you. No, it's a common comment we hear, and it's certainly understandable, and it is newly accessible. But this farming is nothing new, but it's very much taken for granted, and I do think consumers realized last year that we do take it for granted, and investing in our supply chains matters now more than ever. And so, I think when you look at farmland as an asset class and you look at the different ways to gain exposure, there are, there's a spectrum of ways to do it. I think probably the least direct way would be to invest through public equities. There is no perfect ETF basket or index that gives you the same exposure, same risk profile and return profile to farmland as if you had owned land yourself. You can look at ETFs and public equities that are related to agriculture, like perhaps John Deere. But John Deere is not in the business of managing farmland. It's an incredibly capital-intensive company that manufactures equipment and sensor technology and a bunch of other technology. And so that we would argue that really is not giving you the same risk return profile as farmland would. As we move down the spectrum, there are farmland REITs. A REIT is a real estate investment trust, and those are publicly traded. There are two major ones for farmland in the United States. And we would argue that REITs give you much more exposure to direct land, to the profile of risk return on direct land compared to like a public equity strategy. However, there are also limitations with REITs. In order to be a REIT, the REIT needs to derive 90% of their operating income from leases. And so this limits the strategy that a REIT manager can take, and effectively means that almost all their properties are going to be managed as leases versus what would be called a direct operating model, where instead of renting out the land to a tenant, you instead hire an operating partner to manage the land, and you have full economics on the production of the land. So you're collecting operating income as opposed to rental income. So even though the REIT is a better option than public equities in terms of matching the profile of risk return for farmland, because of that legal limitation around how a REIT can derive income, it's a little bit skewed. And then further on the spectrum would be directly investing in farmland, which is of course the best way to replicate the risk and return of owning land. There's a variety of different ways to do it. Some investors grow up around agriculture or live near farmland, and so they're able to acquire farmland on their own and lease it out or manage it or hire an operator. But I would say that's certainly the exception and not the rule. And so there are other avenues as well. There's farmland funds that have been around for several decades now. But typically these are closed-end funds that have very high minimums and at least historically have largely served the institutional investor community. So that would be like pension funds, endowments, plan sponsors, that group of investors. For retail investors, those minimums are usually very high and out of reach. And so now there's a new group, which FarmTogether is proud to be a part of, which would be crowdfunding for farmland investments. And so this takes the same model that other crowdfunding investment providers have offered in real estate and other asset classes, but for farmland, where we'll acquire, I think our last deal, which was an organic apple orchard, was it was a $22 million deal. The equity of that was about 14 million. 14 million is a huge equity ticket for almost any retail investor, and obviously it could be well over 100% of a portfolio. But when you divvy that up across hundreds of investors, it becomes more digestible and more accessible. And so that's how crowdfunding works. Our minimum investment is $15,000 for that deal and for most of our deals. And I know many of our peers have minimums around the same level. And in these types of arrangements, you are a partial owner of an LLC that holds title to the farm. So you have basically replicated the risk return profile for farmland, which I'm happy to share more about how U.S. farmland has performed over the past few decades, if that's helpful, Barbara. But one of the reasons why we think it's such a great asset class is because of its historical performance and now how it has done in the great financial crisis, in the dot-com era, in the hyperinflation decade of the 1980s, all these different, I'd say, turbulent economic times where farmland still managed to perform in a rather consistent way.
Well, that sounds like a very nice alternative for part of an investor's portfolio, because as we typically discuss, you want to maintain some diversification in your investment portfolio. You don't want to put 100% in one stock or in one asset class. And so investing in an alternative such as farmland might be appropriate for a portion of your investment portfolio. But before we close, David, I want some information about what are the risks, because one thing that concerns me as a potential investor would be if I just invest in one project and something happens, what's the total amount of loss I might experience? Because $15,000 for many investors is appropriate. Many investors could probably hit that target, but a lot higher in order to diversify across farmland. If you needed 200,000, well, that's a little tougher nut to crack. So tell us about the risks.
Certainly. So, I would say the risks would principally be if there were a natural event, a wildfire, a flood, something that would, especially if it were a permanent planting, because farmland broadly is divided between permanent plantings and row crops. Permanent plantings are would be like almond trees, hazelnut trees, apple trees, wine grapes, table grapes. It's a long-lived asset. You're depending on that same vine to produce wine grapes for 30 years. You're depending on that same almond tree to produce almonds for 30 years. If something happens to that mature asset, the asset being the tree in this case, obviously your future cash flows are impacted. Versus annual crops like row crops like corn, soy, and wheat, which can be replanted every year. So if there's a wildfire that damages some trees on the property, that would be a material risk. The risk for farmland, we would say, in any of our investments, our investors are never at risk to lose more than the principal that they invest in the deal. We do take on leverage on some of our properties, but it's always non-recourse debt. And so that would limit the liability to just the investor's principal. However, we also think that the historical performance of farmland is very compelling because land generally has not depreciated in value. Land has, very consistently appreciated in value. And so you almost always, you have to qualify, but you almost always can be assured that the underlying asset, which is the land itself, has a residual value. We call that bare land value. There's always going to be some value to that piece of property, regardless of the state of the trees or the state of the vines or whatever that may be. So all that to say, it is possible for an investor to lose their full principal in one of our deals. We think it's extremely unlikely because there is a physical asset, which is the land itself, that preserves a good amount of value.
And what is, you kind of danced around the historical returns, and we always like to know, not that you're definitely going to get this return. We understand that. And this is the history, and it's not a projection into the future, which, as far as I know, I've yet to find the perfect crystal ball. So if you can give us a range of what historical returns on average an investor might expect.
Yeah, absolutely. So, I think one place to start if you're interested in learning more about farmland investing would be looking at a baseline index, which is called the NCREIF. And it's an index that real estate managers use to measure real estate performance as well. So the NCREIF has a real estate index benchmark, and they also have farmland, they also have timberland. And so we use NCREIF since that looks at returns back all the way from the early 1990s. And so when we look back to the early 1990s at farmland returns, it's basically the inverse of the S&P 500. Average annual returns for farmland have been north of 10% with a variance or a volatility of about 7%. And that's derived from both income, which you're going to generate from either rents or from operations, and the appreciation of the asset. So 10%, give or take, annual average return, and 7% volatility. The S&P 500 is essentially the inverse of that. An average annual return of, and for timing, I'm referencing the about 1991 to, I believe, 2019 period. So roughly the past 30 years. S&P 500 over that same period, I believe, has an annual average return of around 6.5%, maybe 7%, with average volatility of, I believe, 13%. So a lot less yield and a lot more risk for public equities.
Well, I'm going to have to fight with you here for a minute, David, because when we look at the returns of the S&P 500 with reinvested dividends, not taking into account inflation, I can't speak for the last 30 years, but I can say that historically over the last 100 years, over the last 50 years, the S&P return has been about 9%. Recently, it's been stratospheric, which suggests we may be in for a little bit lower returns going forward. But before we wrap it up, I'd like to know if investors are interested in learning more about farmland investing, and FarmTogether specifically. What are the qualifications for someone to invest in your platform?
So the qualifications for someone to invest in our platform, if they're a US-based investor, would be the accreditation standard. So for accredited investors in the US, generally that can be met by meeting an income threshold of $200,000 in income per year for 2 consecutive years for an individual, or $300,000 for a married couple. Could also be met by net worth. So if a family has a net worth or an individual has a net worth exceeding $1 million, they would be considered accredited. And also, this is fairly new, but now there's also a knowledge qualification as well. So if an individual has certain financial licenses, such as a series license, like a Series 7, or a chartered financial analyst designation, a CFA, they may also be considered accredited.
So they may be considered accredited even if they don't meet the income or net worth standards. Is that correct?
Correct. If they meet one of those knowledge criteria, yes. And that just went into effect, I believe, in December. So that's very recent.
Well, David, thank you so much for talking to us about FarmTogether, about climate change, about alternative investments, and the correlation between those type of investments and historical stocks and bonds. We're going to have below some links both to the FarmTogether platform, some articles, some information about the index, as well as alternatives for investors who aren't quite at the accredited investor level yet, but are interested in this asset class. Please be aware that if you do click on an affiliate link, and those will be labeled, we will get a small commission that will help pay for this channel. So thank you so much for stopping by. If you like this video, please give us a thumbs up and subscribe, and we will see you next time. And David, thanks so much for showing up and sharing your knowledge and information with our viewers today.
Thank you, Barbara.